The broadcast is now starting. All attendees are in listen-only mode.
You are complaining that you cannot hear me. I hope now it's a little bit better, but I'm going to come up with some slides on what you can do if you still can't hear me properly. So I'm going to talk about retirement pensions. I'm going to talk about a new term which is called the retirement phase. I'm going to talk about merging pensions. Is that still a good idea? And I'm going to talk about a new item which is called the balance transfer cap amount. I'm going to talk about recontribution strategies. Are they still alive? And I'm briefly going to talk about what are two funds. Can one client have two funds, one a pension fund and one an accumulation fund, and what the benefits are of having two separate self-managed super funds. Now, if you can't hear me, please have a look at your panel. On your panel, there is a phone number. Um Earlier on, we were noticing that Citrix was using Melbourne phone number, but now I'm told they have a phone number which is in Sydney. So it's a local number which you'll be dialing probably from your mobile phones and then listening to me and watching the screen. Now, I cannot do anything better than what I am at the moment as far as your audio is concerned. Once you dial in that number, you'll be given a PIN, and the PIN is on the panel. And once you enter that access code, you'll be able to hear me. Now, the handout is now uploaded on your panel, so this presentation can be downloaded by you if you want to discuss it with your staff members. Now, this topic is a little bit complicated, uh, uh, so I will, just finish my presentation. And if you have any questions, there is a question area in your panel, and what you can do is you can keep on typing your questions, and right at the end, I will discuss these questions with everyone, and those who don't have a question can also hang out and see what other people have to talk about. Now, there are no papers along with this presentation. I'm just going to record this presentation, and once it is approved by the Financial Planning Association of Australia, we'll probably upload it on our website. But the good news is that we have now created a new website which is called smsfschool.com.au, and we will be presenting all our webinars. And the best part is I will not be the only speaker. We are talking to other speakers, and we are charting out a plan for the whole year 2018, the calendar year 2018. But there are still two free webinars you can take benefit of, and they are on 23rd November on total superannuation balance and the ins and outs of borrowing from a related party by a self-managed super fund on 7th of December. So you can go to the online SMSF audit website, and you can book the webinars. Now, what we have now from 1st of July is that trustees have to maintain several accounts for each and every member. So you see 4 accounts. So if you have a self-managed super fund with 4 members, then and if all 4 of them are in pension, uh, then the trustee will have to maintain pension accounts for each member. And it's possible that they'll have multiple pensions, but it's quite likely, because the balance transfer cap is only 1.6 million, that most likely you will consolidate all the pension accounts and have one pension account. And you're supposed to maintain a separate balance transfer cap amount or balance transfer account. And I'm going to talk about what are those debits and credits very soon with you. And if the member had more than 1.6 million on 1st of July 2017, you'll be probably maintaining an accumulation account of the member as well. Now, the last one is the asset pool account of the member, and I'm going to discuss this. And this is a new concept which has come up, a new strategy which has come up, and I'm going to discuss that a little bit later in today's presentation. Now, what I've also put here is that for a pension account, you must have a segregation or a separate total of taxable and tax-free component. That is, when the income is credited to the pension account, the taxable component goes up in the same proportion as the tax-free component, and that percentage is set at the commencement of the pension. Now, as far as the accumulation account is concerned, you may have a taxable and tax-free component, and when you credit income in the accumulation account, only the taxable component is increased and not the tax-free component. Now, the taxable component is the component where someone has contributed for a member and the fund has paid 15% tax on it. And if there is income in the fund and that income has also paid 15% tax on that taxable income, or 10% tax where it's a capital gain. Tax free component is basically non concessional contributions, after tax contributions, government co-concessional contributions, so where there's no tax being paid, but however the amount sits in the credit of your superannuation interest in your self-managed super fund. So as I said, that I'm trying to make this as entertaining as possible for you, but I think picture talks about 1,000 words. So I'm trying to convey a message more by pictures than by words. However, I'll have to fall back on words on certain slides because the message just cannot be put across. Now, those of you who have never had a fund, never ran a pension, it's not difficult. It's very easy. Um, and it's very easy to run because once you have a member in the fund, the only thing which you really need to worry about is that the pension is below 1.6 million, the balance transfer cap. And secondly is that the member of the fund has withdrawn a minimum amount, and I'm going to talk about what is the minimum amount, minimum pension every year or not. So if you just look at these two basic requirements, you'll be doing all right. And slowly you can increase your knowledge over the years. And when you have more clients with pensions, things can get complicated, and there are a lot of strategies, and which I'm discussing here, some of them, and you will be learning as you will have more clients who have pension accounts. Now, basically, the pension standards must be kept every year, and we're talking about an account-based pension where the member has certain dollars, and if you withdraw certain dollars, then it is possible that the pension can finish off. That means there's no money in the pension. So withdrawals can actually, or negative income can actually reduce an account-based pension for a member. So we have to follow the preservation rules from 1st July 2017. Its age is 57. It depends on when you were born. So if you were born 1961, you have to be 57. So if you add it up, you'll end up with 57. So as long as the minimum pension payment is made and the pension account will not pay any tax. That means that if the pension is below the balance transfer cap amount, any income which you credit to the member, there will be no tax applicable on the income which is supporting that pension. Now, if you have a member which has more than 1.6 million, that means the balance transfer cap has been breached. You will have an accumulation account for that member, or the member can withdraw the money out of super, or you can have a situation where there are other members who have not reached the preservation age and they have accumulation accounts, and then you will be paying some tax on some of that income. And we're going to talk about how that is calculated. Basically, you declare all the income and then you claim an exemption, and the exemption is called current pension income deduction. So, current pension means those members who are receiving a pension currently, so all those assets which are supporting a pension currently. Now, when you commence a pension, you must read the terms of the trust deed of the super fund. Um, so, what you need to do is every trust deed has certain documentation, certain requirements on how to commence a pension. Usually, it's known as a pension agreement, and in the pension agreement, there are certain terms on how often the pension will be paid, and especially what will happen if the member dies, whether there would be a binding death nomination in place, that is a lump sum being paid to certain dependents, or whether there's a non-binding death nomination in place along with a pension agreement. And if it is a pension agreement, whether on death it will revert to a dependent or not. Now, reversion means that the pension can continue, and the person who receives the pension, the beneficiary of the pension, must be a dependent of the member. Now, I'm not going to talk about who is a dependent, because I'm sure you can look into the legislation of the definition of a pension. And as we stand, some of those pieces of legislation will get amended depending on how the gay marriage vote comes out. So it's possible that definition of spouse may be changed very soon if the gay vote is a yes. Um, we'll see how it all falls into place, but as long as we are aware that a pension can be reverted, and you must remember that whoever is the beneficiary must be the dependent of the member, that is, on the death of the member. Now, there's another type of pension which can be paid from a self-managed super fund, and it's called a transition to retirement pension. Basically, the requirement or the difference between a normal account-based pension and a transition to retirement pension is that the pensioner is working for more than 10 hours per week. Now, because you've reached the preservation age, which is 57, and if you're working more than 10 hours per week, you cannot commence a pension, which is an account-based pension. However, you can commence an account-based pension, which is a transition to retirement pension. Now, there's very little difference between an account-based pension and a transition to retirement pension. Basically, transition to retirement pension is a subset of an account-based pension, but transition to retirement pension has certain features. And one of the biggest feature from 1st of July is that it is not in retirement phase. And because it is not in retirement phase, all the income allocated to transition to retirement pensions will pay tax. So it is just like an accumulation account in a self-managed super fund. Now, the difference between an accumulation account and a transition account, a transition to retirement pension is more closer because both of them pay tax. However, a member can withdraw from an account-based pension, which is a transition to retirement pension, whereas a member cannot withdraw from an accumulation account, a pension. If the pensioner is over a certain age, only then he can commence a transition to retirement pension. The other subtle difference is that the person, a member who's withdrawing a transition to retirement pension, must adhere to the minimum pension requirement. However, there is additional requirement that the member cannot withdraw more than 10% of the balance on 1st of July. I'm going to talk about minimum pensions in the next slide. So whatever is the balance on the 1st of July, or if the pension commences in the middle of the year, whatever is the balance at the commencement of the pension, the person who's withdrawing a transition retirement pension cannot withdraw more than 10%. There's another difference, which is a very subtle difference, which is about commutations. That is, transition to retirement pension cannot be reverted back to a normal accumulation account if the member continues to work. So he must retire before the transition to retirement pension can be commuted. There are other differences as far as on death is concerned, that a reversionary pension cannot be paid to a dependent. That means it cannot revert to a dependent because the eligibility of the beneficiary is checked before it can be paid. So a transition to retirement pension must be converted to account-based pension if you want that transition to retirement pension to be a reversionary pension. And this is where you will read a lot of stuff in the media, and a lot of specialists are talking about it, that why can a transition to retirement pension cannot be paid to reversionary dependent pension. So it can only be paid as a death benefit. Now, the difference between a reversion pension and a death benefit is that if it is paid automatically as a reversionary pension, the balance transfer cap gets credited to the beneficiary's account after 1 year. Now, those of you don't know what I'm talking about, you have to watch my presentation about the balance transfer cap. So the difference between a death benefit pension and a reversionary pension is a death benefit pension credits the balance transfer account of the beneficiary immediately, whereas the reversionary pension credits the balance transfer account of the beneficiary after 12 months. Now, pension can be commenced anytime, but you will notice, because it's very unlikely that your client will turn 57 on the 1st of July. So it's quite likely his birth date would be any other date than 1st of July. So you can commence a pension at any time of the year. Now, just before we proceed, if a member is 57 years old or over and he's not working, he can commence an account-based pension, and it does not need to be a transition to retirement pension. So, a transition retirement pension is only to be commenced when the member is working and the member is not retired. The meaning of retirement is working less than 10 hours per week. So before you commence a pension, you need to check with the member whether he's working or whether he's not working, so that you are able to decide whether it will be a transition to retirement pension or whether it will be a straight, simple account-based pension. And there's a huge difference between a transition to retirement pension and an account-based pension, because an account-based pension uh, will not pay any tax on income credited to it, whereas a transition retirement pension will pay 10% tax in situations of capital gain tax and 15% tax on normal interest and dividend income. So we have to check the preservation age and then we commence a pension. And you will have to prepare a set of financial statements. You must value all the assets of the fund, and you must do everything which you have to do on 30th of June, except you don't have to lodge a tax return and you don't have to get it audited by a super fund auditor. So other than that, you'll have to do everything. You'll have to prepare the accounts, value all the assets to market, and then you'll have to check the member balance and test whether the balance transfer cap is breached or not. And you can only transfer 1.6 million, which is the balance transfer cap, into retirement phase for the member and commence a pension for only that amount. Now, we're not, in today's presentation, we are not going back, we are not going before 1st of July of whatever has happened. So we're talking about commencing pensions from 1st of July onwards. Now, let's talk about balance transfer cap and what are the debits and credits of a balance transfer cap. Balance transfer cap started from 1st of July. So if you are moving into accumulation phase to pension phase, that is a tax-free retirement of 1.6 million. If you have a balance, if a member has a balance more than 1.6 million, you have the choice is that you can withdraw from the superannuation system altogether. That is that you commence a pension only with 1.6 million. Anything above that can be paid out as a lump sum. Now you must remember that if you are working, you cannot get paid out, and if you are below 60. So anything which is withdrawn out of super above the low rate threshold, which is $200,000, could be taxable in the hands of the member. But what you can do is that if you want to retain the money in super, it's called an internal rollover. So basically, what you're doing is that you're commuting the excess back. So you commence a pension with the whole amount and they commute it back, or what you do is that you commute the amount above 1.6 million, or the other way is to just commence a pension for 1.6 million and then the remainder remains in your accumulation account. So you have two accounts. You have a pension account and then you have an accumulation account. It's only valid for those people who have more than 1.6 million in their superannuation interest. Now, after a fortnight, I'm going to present on total superannuation balance, and I urge you to book yourself for that because there is a new concept. We're not talking about your total superannuation interest, we're talking about your total superannuation balance, which is again a new concept from 1st of July, and we'll be discussing on how you can reduce or add to your total superannuation balance. Now, one thing I must note, if your member has other superannuation accounts, so it's possible that a member has an AMP account and when he reaches the preservation age, he commences a pension from that AMP account. Now, the total transfer cap, balance transfer cap, is 1.6 million. So if he has already commenced a pension, say with $1 million in AMP, he cannot have a pension account in his self-managed super fund for anything more than 600 because 600 is the only gap between his uh, amount which has already moved to the retirement phase to the balance transfer cap amount. So his total balance transfer cap amount, whether in super, in self-managed super fund or outside, is 1.6 million. So this is probably the first time you'll be talking to your clients and asking him whether he has any other money in superannuation which is outside of super, and if that money is in pension or not. So if you do not do that, then you will incur what is called a excess balance transfer the cap tax, and today's presentation is not going to go into that amount. So as long as you are aware that any amount which is more than 1.6 million in pension phase will be paying some extra tax. Now, why did we have a balance transfer cap of 1.6 million? Basically, the Fair and Sustainable Act of the TLA 81, which was announced in the 2016 budget, talked about that we cannot have members with unlimited amounts and all those in pension, and all those incomes would be tax free. So what it does is it limits the amount of earnings that are exempt from income tax. So the phase, the new item or the new thing which the legislation, the TLA 81 talked about, is the retirement income phase. So it's no longer the pension phase, it's the retirement income phase. So that was limited to 1.6%, 1.6 million, and it would be indexed only by 100,000, and that's by CPI. And looking at the current CPI, which is about 2%, I think we'll have to stick with 1.6 million for at least the next 10 years. Now, this balance transfer account works like debit and credit, and there are lots of things which will credit it. So when you commence a pension, it will credit the balance transfer cap account. So you'll have to maintain somehow. I don't know whether it will be an Excel sheet, and hoping that the online software providers like BGL 360 and Class will have some sort of an accounting system where uh, the administrator will be able to manage it along with the set of accounts. But if you do not subscribe to those online specialist accounting softwares, then I guess you'll have to maintain a separate account outside of the accounting system. Now, any amount which commences a pension or any reversionary income stream, so that means that if you have a member and that member has died and you are the beneficiary of that member, any of that pension coming to you, that means you're a beneficiary of an income stream, will also credit your balance transfer cap amount. Now, if you have extra money, the excess transfer balance earnings will also credit it. I've just put it here, but I think it'll be a discussion for another day. Now, there's another thing which was inserted at a later date, and what the legislators are talking about is that if you pay off um, any LRBAs, any loans from an accumulation account, and it increases the value of the retirement phase income stream. That means that you're reducing the liability of the fund. That means the fund does not owe any money to an outsider, but that payment has been made from an accumulation account. And what that does is that although the liability of the lender has decreased, but what has happened is it's increased the retirement phase balance of any member. That means any money moving from accumulation to pension via a payment of a loan can credit your account balance. Now, there is provision in the Act where if you get divorced and you are in pension, your partner is also in pension. If you receive any split due to family law, that will also increase your balance transfer cap. Now, let's just talk about death benefits, which are not reversionary income streams. So it's possible to get a death benefit. So you could be a dependent, and the person who has died um, has not got a reversionary pension. So on death, the trustee can decide to pay you a death benefit pension. And the difference between a reversionary income stream and a death benefit income stream is basically that the trustee had some sort of a discretion to commence a death benefit income stream instead of a reversionary pension where the trustee was forced to pay the beneficiary automatically upon the death of the member. Now, your transfer balance cap can reduce if you commute a pension or if there are any structured settlements. Structured settlements are in cases of personal injury. So, if you receive any money as a compensation and if you contribute that compensation into your self-managed super fund, so basically any contributions due to personal injury will not increase your transfer balance cap. So you could have more money, more than 1.6 million in pension phase, provided the excess amount is due to a structured settlement. Now, self-managed super funds have been target for many frauds and void transactions. So if any of that happens, then you could request the regulator to create a debit in your balance transfer cap, or if there's a payment because of divorce to your partner, and if you're reducing your pension account, that can also debit your balance transfer cap amount. And if for some reason, if your pension is no longer complying to the pension standards, and for example, if you haven't paid a minimum pension amount, that means that you did not have a pension in that year. So any money which comes out of the retirement account and forcibly goes into the accumulation account because you have not kept to the pension standards, that will also debit your balance transfer cap amount. Now, um, as far as the balance transfer cap and death is concerned, basically, if anyone dies, that payment must be cashed out. That's this regulation 6.21, and it must be paid out as soon as practical. However, it is possible, and if your trust deed also allows it, that the death benefit can be paid as an income stream to the dependent beneficiary. So it's a matter of what you want and whether you have debts outside of super. So if you have a home loan and your partner dies, it's probably advisable, or if you discuss it with your financial planner, probably you would like to reduce your debt instead of commencing a income stream. But if you're working, then you don't mind the home loan which is outside of super. So it all depends on what you want. And the best part is that the legislation allows you to have a combination. So you can have part payment as a lump sum and you can have part payment as an income stream as well. Now you must remember, if you're not a dependent, so the member dies, so the member of the fund dies, so this is a self-managed super fund, and you're not a dependent. And of course, you must understand who is a dependent and who's not a dependent. So a child, let's say over the age of 18, is not a dependent, but a child who's studying full time is a dependent between 18 and 25, but a child over 25 is not a dependent. So if you have a parent and you are working, you automatically become a non-tax dependent of the member, and that means that the death benefit can only be paid as a lump sum, and once it is paid as a lump sum, it will not credit your account because you're not receiving a pension. So if a lump sum is received by a non-dependent, the money is receipted outside of superannuation fund and it doesn't remain in super. Just to mention here, if a death benefit is received by non-dependent, any taxable component will pay 15% tax plus 2% Medicare levy. So this would be helpful to us if we are talking about any recontribution strategies which are available to members so that they can recycle the taxable and tax-free component in their pension accounts, because if they have only non-dependents, Now, how will you have non-dependence? Let's say if there's a husband and wife situation and one of them has died, and there is only one of your parent, and all the kids are over the age of 25. And if the member has taxable components in the fund, and on the death of the second person, let's say the second parent, then the beneficiaries will pay 15% tax on the taxable component. Now, this 15% tax on the taxable component could be a huge amount. So let's say if you have 10 million in super, we're talking about paying 1.7 million in tax. So recontribution strategies may not be possible, and I'm going to discuss that very soon, because you cannot recontribute into super once you have 1.6 million. I'm going to talk about that a bit later, but what needs to be considered is that instead of paying on that 10 million death tax of 1.7 million, it will be a good idea that the member actually withdraws the money while he is still alive and keep the money outside. So upon death, that cash can actually go to non-dependents and there will be no tax paid at that time. Now, if the dependent is a tax dependent, that means on the death of the member, you can either pay a reversionary pension, and if a reversionary pension is paid automatically, it credits the balance transfer cap of the beneficiary after 12 months. Whereas if a death benefit pension is paid to a tax dependent of the member, then it credits the balance transfer cap immediately. So that is why it will be a good idea to look at all your pensions, whether they are reversionary pensions or they are death benefit pensions, because the credit goes to the dependent after 1 year, and the beneficiary has 1 year to actually manage his own affairs. And there are lots of things which the beneficiary can do. Now, it's possible that the beneficiary himself is, we're going to kill the wife here, so because I have a male picture here. So the wife has died, and the reversionary beneficiary is a male, and the male could be on a pension, and if he's on the pension, it may cause to exceed the balance transfer cap. So the dependent, the spouse dependent, may be on pension or may not be on pension, but may be on pension. But if it is a reversionary pension, it'll credit the balance transfer cap of the beneficiary after 12 months. So you've got 12 months to manage your affairs, and these are the things which you can do. First thing is you can commute your own pension and withdraw as lump sum out of super. So this is an option where you are withdrawing the money outside of super. So you commute your own pension and withdraw it as a lump sum, or you can do another thing is that you can commute the pension of the deceased and withdraw it out of super. So you can withdraw out of super either your own money or the money of the deceased. Or if you want to retain the money in super, so you want to retain all the money of the reversionary pension into your account. So what you can do is you can commute your own pension, and then the commutation means that your pension will be converted into an accumulation account, and then the money which you receive from the from the deceased will credit your balance transfer account. So let's say when your partner died, your pension was 1 million, and the deceased member's balance was also 1 million. So because you're a reversionary beneficiary, and you've received a reversionary pension, your balance transfer account was credited with 1 million, and now there is a new credit coming up for 1 million. So you have obviously exceeded your balance transfer cap amount by 400,000. So what you can do is the 1 million coming from here, or the one your own 1 million can be withdrawn, or 400,000 can be withdrawn, and um, uh, or you could, out of the 1 million coming from the deceased, you could withdraw that amount out of the lump sum, and the remainder 600 could be added to your own. Now, one thing you must remember, that whatever 1 million is coming, that cannot be retained in super. So you can convert your 400,000 into accumulation, and if you do that from 1 million, if you commute it, then your balance is only 600, and then you receive a reversionary pension of 1 million, so your balance remains at 1.6 million. But what you cannot do is you cannot commute the deceased pension and retain in super. So because of the condition which we spoke about here, that regulation 6.21 of the SIS regulations talks about that any death benefit creates a compulsory cash in, so it must be paid out as soon as practical. So you can commute your own pension and leave it in the accumulation account, but you cannot retain the deceased member's pension into the super fund. Now, TRIS works in a different way, and we spoke about it earlier a little bit. TRIS basically cannot revert to a beneficiary, and this is all happening now, and there's still a lot of confusion, and the ATO is also reconsidering lots of things on this issue. So we are looking at a situation where the deceased member has a transition to retirement pension, and he and she dies, and there's a reversionary beneficiary, and the reversionary beneficiary wants to retain the money in the super fund. Now, the current situation is that there'll be no credit to the balance transfer account because it's a transition to retirement pension, and because she died, so we have to check whether he can receive a transition to retirement pension or not. And the situation why he cannot receive a balance amount of the deceased is because maybe he is below the preservation age. And if he is below the preservation age, then obviously he cannot receive the reversionary pension of a TRIS. So, what are you supposed to do? You have basically no choice. The transition to retirement pension will become a death benefit pension, and there will be no automatic reversion. And the only choice is that it will credit the dependent's balance transfer cap automatically instead of crediting in a reversionary method after 1 year. Now, there are a few situations where a TRIS can convert into an account-based pension. However, the member who's on transition to retirement must notify the trustee of those events, and those events could be, let's say, if you stop working. So you've met a condition of release with nil cashing restriction. So you're no longer working. So because you're no longer working, so the condition that it should be a TRIS is no longer. Those two limitations of 10% just automatically fall away, and non-commutation just automatically fall away. So automatically the TRIS can become an account-based pension. However, what the legislation says that there has to be something which has to be done, which is a notification by the member who is no longer on TRIS to inform the trustee, so that the trustee um, creates or does some minute, or probably redo the pension documents again, and reclassifies the transition to retirement pension as normal account based pension. Now, there is one big confusion on transitional CGT relief, which was available till 30th of June 2017. And if you have not availed it from 1st of July, it does not apply anymore. So we don't have to talk about it today. The only mention, the only thing which I'm going to mention is that when you lodge the income tax return, you're supposed to make an election. And if you look at question number 8, the tax office has inserted, have you chosen to apply a transitional CGT relief or superannuation fund? You say yes or no. And if you want to defer the amount, you have to enter the amount of the notional capital gain which you want to defer. Now, I did a presentation some weeks back, and a copy of that presentation should be available on the website, and you can watch that. At the moment, I think we are in the process of getting it credited for CPD hours from the Financial Planning Association. Now, let's talk about running a pension with an accumulation account in a self-managed super fund. So we are now in a situation where the member has more than 1.6 million, and we do not want to withdraw the money out of super fund. We want to retain it in super, because if you withdraw it out of super, then it's possible that income is taxed at a higher rate than 15%. And if we leave the money in super, then the maximum tax rate is 15%, and the money can be withdrawn at any time provided you're not working. Uh, I'm going to lead you to the situation that an accumulation account will always pay tax. It is not tax exempt. And some of the income will be taxed and some of the income will not be taxed. And that's governed by Section 295, 390 of the Income Tax Act. And they talk about current pension liabilities. So you may have a situation where you are a single member in a fund, and because you can only credit your retirement phase with 1.6 million, and if you have 2 million, it's possible that 400,000 is in the accumulation account. So we check all the income and we look at the proportion of income which is which is paying a pension, and the proportion of the income which is not paying a pension. So what you're supposed to do is, under the act, use a formula, use a percentage. And the act also requires you to get actuarial certificate from a qualified actuary. So it's a simple formula. So 1.6 million divided by 2 million will give you the answer. And there is a word called average, because what happens is that whatever is the opening balance of the pension account is not always the opening is the closing balance of the pension account, because you make several pension payments from the pension account, and also the accumulation opening and closing balance are never the same, is because you make contributions into that accumulation account. So some actuaries use a daily balance method, some use a monthly balance method, and some use quarterly method, quarterly average balance method. So it means that your proportion could be different each time depending on which actuary you go to, and the percentage of exempt current pension income could be very different. Now, on 30th of June, when there is an accumulation account, I just want to highlight one thing which is very, very important. So, on 1st of July, you could commence a pension, or you already had a pension of, say, 1.8 million. So during the year, you withdrew some money, and the new balance is on 30th of June or on 29th. The reason I put 29th is because on 1st of July, you cannot have more than 1.6 million. So what you need to do is you need to do a set of accounts on the 29th of June. And the reason you need to do the set of accounts is because you need to value all the assets. Because on 30th of June, you have to have only 1.6 million, so that on 1st of July, your pension account does not start with more than 1.6 million. So you have to do two create entries if you're using BGL 360 first on 29th of June, see what the balance was, and then credit the account. And once it's credited, then you have a new balance. Once you have that new balance, then you can only keep or credit your pension account with 1.6 million, and the remainder account will go into an accumulation account. Here we are seeing that from 1858 the balance has come down, and now we have an accumulation account. Now if we are receiving monthly payments on the last day of the month, so let's say the super fund owns one property and the rental income comes once in a month, and if you have received $10,000 on the 30th of the month, on the last day of the month, that means on that day, some of the income will be taxed because we had an accumulation account. So as long as you appreciate and understand that. And then on 1st of July onwards, you are maintaining an accumulation account and you will need an actuarial certificate. So you will need an actuarial certificate for this period, that is from 1st of July till 30th of June. Now, the actuarial period, the way the industry looks at it is that it is for the whole year, and that's how they have been applying it. So they look at the opening balance of the pension account, and then on this date, on the 29th or on the 30th, I think on the 30th because the accumulation account creates on the 30th. So on 30th, what they will do is they will basically commute the whole amount of the pension. So whatever the value was of 1775 will be commuted. And then on the 30th, they will commence a new pension with 1.6 million for only one day. And then they will commence an accumulation account for 175,000 for that one day. Now, if you're using an automated system through an accounting package, and if your member balance is 1.6 million, let me tell you, the calculations done by the accounting package is wrong. And I don't care uh, which actuary you go to, but if you apply online, because I know for a fact those accounting packages I have not been upgraded as yet to understand this, and the online form is not yet upgraded as yet. So if you are an auditor, and the first thing you should be looking at is whether the fund has received any income on that 30th of June or not. And if it has, there should be some tax, although this fund looks like 100% segregated fund because all the members are in pension phase. But because the balance was more than 1.6 million, on one day the fund had more than the pension account, it had an accumulation account, so some of the income will be taxed. Although the figure could be very, very low, but there will be some tax. And you also, if you're an auditor, you have to see whether the trustees and the administrators have applied for an actuarial certificate, whether that actuarial certificate is correct or not. Now, the actuarial period is only one day, and what the tax office has said. Now, you must see what the industry practice is. What they do is they look at the opening balance on 1st of July, and then they'll kill the pension and then commence a new pension on 30th for 1.6 and commence an accumulation account on 30th of June. Whereas what the tax office is saying that uh, the period when the fund is 100% in pension phase, you don't need an actuarial certificate. So you're not supposed to use this as an opening balance. What you're supposed to do is you're supposed to use 1.6 million on that day. So this income will be taxed according to this percentage. But what the tax office has come up with is that we are happy to ignore or not put our resources whether a fund has used this system. If the fund uses this system for 30th June 2017, they are happy for it. But from 1st of July onwards, from this date onwards, they must use the ATO's view. And the ATO's view is very clean, and they say that whenever the fund has only pension members, then you don't need an actuarial certificate. Don't worry about that rental income because all that rental income is exempt. You look at only the period, the time when the fund had a pension account and an accumulation account. And there are problems in calculating it their way. So let's look at from for the current period, that is from 1st of July to 30th of June. So let's say we started, a green one is a pension account and the yellow one is the accumulation account. So let's say we were running a pension and in the middle of the year, any day of that middle of the year or whatever date of that year, there's a large contribution in the fund. Now, this contribution could be by the same member or could be by other member, it could be a rollover or could be anything. So once that money comes in, so this period, basically this period is exempt. So from this date to this date, you don't have to worry about the income. So what you need to do is you need to do a set of accounts on this date. And then you figure out and credit the pension account with all the income with the market value of all the assets. So you got to value the pension assets on that day and you calculate the income from this date to this date. So you're basically doing a set of accounts from the beginning of the year till that contribution, and you cannot claim any expenses if you because you are 100% in pension phase. And once you remain in pension phase, you don't worry about the income because all that income is tax free. But from this date onwards, what will happen is that you will have to claim ECPI percentage from an actuary, and then you find out what was the opening balance of the pension account, what was the opening balance or what was the amount which was contributed, which remained in accumulation till the end of the year, and then you work out the income which was earned in this period, and that income will be apportioned and not the total income of the fund. So the industry has come up with a solution, and the solution is very simple. Because you don't have an accumulation account, that is why we have a problem. So all we do is we, like in the problem here, is that because we did not have an accumulation account in this period, so if I keep $1 in accumulation that period, then what I can do is that my period will now be the whole period. So I did have an accumulation account, I did have a pension account, but I had only $1 here. So when I work out the percentage, I can worry about the income of the whole year because the whole year I will need an actuarial certificate. But the percentage would be quite in the favor of the pension account because we have 1.6 million in pension and we have only $1 in accumulation. And even if a large amount comes as an accumulation, then the whole period, the whole year's income will be included. The reason for that is that it's quite possible that in this period we may have more income and less income in this period because dividends are paid on 6 monthly basis. So it's quite possible that we may have larger income wherein accumulation account is there. But with this method, we can use the opening balance also of the pension account, and the period can be 365 days instead of a shorter period where there was larger income and there was a large amount of accumulation account in the fund. Now, if you're worried about what are you going to do because you cannot use an online system, and if you have used an online system, and if you're auditing a fund which has which has purchased a actuarial certificate online, and you can go to ecpi.com.au where you can buy an actuarial certificate for $55, or you can go to online SMSF audit if you are using. So even on online SMSF audit, actual certificates are available for $55. Now I'm almost on the last leg, and I'm quite concerned about the time I'm taking. It's 4 o'clock. I'll try and finish it in the next 10 minutes. So we are now talking about a new concept, that is segregation of pension assets. So now it is possible. So because we have pension accounts and accumulation accounts, but what we can do is we are not allowed to segregate for the calculations of exempt current pension income from 1st of July onwards. However, what we can do is we can have an investment strategy and we can allocate certain assets, not for income tax purposes, but for investment purposes to the pension member. And certain assets to an accumulation member, and you will be picking those assets which have high income to pension accounts, because then after you have done the tax calculation, it is the allocation of income which is important. So after you have paid the tax on whatever amount you have to pay, and remember, all the tax will be paid only by the accumulation account, but you can allocate a higher amount to the pension account. The reason you will do that is because those assets have been in your investment strategy designated or pooled only for pension members. So, this segregation is only if your investment strategy includes, and it must name that asset. And I urge you to read SIS Regulation 5.03, where allocation of income, allocation of tax is all discussed. But again, I must also warn you that before you embark on this strategy, you must also look at your trust deed, whether it allows the trustee to maintain this segregation for investment purposes. Now, if you're using an accounting software, usually the accounting software will credit each and every member on daily balance method. So you have to overwrite that figure. And the benefit of basically doing that is because next year your pension balance is more, because the pension account has been credited with more income. You should also check with your auditor, and if your auditor has a problem, I have seen some auditors, they don't like any other allocation other than the software allocation or a daily balance method allocation. I strongly recommend you to change your auditor so that you're able to credit the pension account uh, dependent on depending on what the pension assets earned in that financial year. Now, are you talking to your clients? This is what I have noticed. We've got trustees asking questions, and I've noticed now in today's presentation, I can see there are about 343 people who are attending it, and there are a large number of trustees who are attending it. And once SMSF school opens, it's quite possible that they'll be getting information, they'll be reading information from all sorts of sources besides coming from you as the accountant. So don't get too busy in doing your work. What you do need to do is you need to talk to your clients, and you got to talk to them about many, many issues. And each client is different. You have to see what they want, and you have to look at each and every fund. What is the taxable and tax-free component? Are there any tax dependents? Are there any tax dependents who can be reversionary beneficiaries? You cannot use one strategy for each and every one of your clients. Can you recontribute? Because maybe the balance is much below 1.6 million. Maybe the balance is only 1 million, but all of it is taxable. So although it's a pension, so can you do recontribute? Of course you can. So what you do is you withdraw the amount and then you recontribute and commence a second pension. You cannot recontribute once you are over 65 and you're not working, because you have to worry about the work test as well. So you got to have a pure communication, and there are lots of things which happen at the age of 60, a lot of things which happen at the age of 65, and you should be aware of those things. And if the total superannuation balance, of course we're going to discuss it in the next webinar, that if the total superannuation balance is more than 1.6 million, non-concessional contributions or tax-free contributions cannot be made. So what are the strategies? What can we do so that if our balance is more than 1.6 million, how we can convert the taxable component into tax-free component? We have to look at the composition of the assets. does the fund own properties? Because if it owns a lumpy asset and if one of them dies, then you have a major problem, because you cannot revert uh, one member's balance transfer cap above the balance transfer cap of the other member. So if the asset is very lumpy, then what you have to do is, because the extra amount of the deceased must be paid out, and if there is a lumpy asset, if there is a huge property, you need to make the client aware that there could be a problem in case of death. And there could be, in case of death, there could be borrowings to purchase property. So you need to look at what the clients want. Does he want those loans to be paid out first and things like that? So you really need to look at the balance transfer cap angle of the remaining trustees in the fund. Now, has the fund invested in private companies? Are there any pre 99 trusts? So your discussions can become really very complicated, and you have to look at the large funds. Can we remove the money out of the system? Because, and you have to look at the age of the member, because there could be some members reaching 80, 85, and if that money is invested outside, would you be thinking of discretionary trust? Or because if that member dies with a taxable component, so with funds which have $7-8 million in there, whether there are any dependents available, and whether the dependents can absorb the balance transfer cap which will come through reversionary pensions or death benefit pensions. And if they can't, maybe you should have an automatic transfer or automatic payment of lump sum. So that means binding death nominations may need to be revisited. And what about mental incapacity? Now, you must understand that once you lose mental capacity, you cannot appoint someone as a guardian. Then what you have to do is, if you get mentally incapacitated, you have to go to the guardianship courts, and the next to kin needs to establish. It takes 6 to 9 months, and it's very expensive. You need solicitors, and all that could be basically fixed in the trust deed. So if you update your trust deed to our trust deed, it includes a provision where the member loses mental capacity, and two doctors classify him to be not capable, then there's an automatic appointment of the legal guardian. So these hardwire clauses are very, very important. So if you enter into a nursing home, so we've made our trust deed in such a manner that you don't have to incur these extra costs. And if the amount is very large, then you have to really think about binding death nominations. Now, one thing you must understand, that a lump sum cannot be a reversionary. So if a person has a pension, then the pension agreement or the reversionary component of the pension component can be controlled by the pension agreement. But the binding death nomination controls the accumulation account. So if you earlier on, because earlier last year you could have 5-6 million in a pension account, so earlier on, or a reversionary pension would be enough. But now, because the member not only has a pension account, he also has an accumulation account. Now you will need both. So, have you organized a binding death nomination for your client or not? That is the key. Now, you have to talk about withdrawal from super, because if there are adult children paying, taxable components and all of that, so all of those things can get very, very complicated. So maybe, he should sign, if it's a single member fund, maybe he should sign on the contract that it's going on auction. So some areas can be dealt with before death. And death is very unpredictable, so it's just a matter of getting the client ready. Now, if the balance is say 2 million and 400,000 is the excess component, it is possible to earn $40,000, in a discretionary trust, or you could even think of an insurance bond, or you could just spend the money. So some income, and because you have senior Australian tax offset, it's possible to earn income outside of super as well. So it's not necessary that 400,000, the excess over the 1.6 million, must remain in super. So you're talking to your clients about recontributions, changing the money. So if you have only 1.2 million, you can withdraw 300,000, because 300,000, the new non-concessional bring forward rule is only 300,000. So you can recycle the money and have tax-free components. Or the other option is that if you have a large fund, so let's say the member is has 5 million, husband and wife team, so the pension can be only 1.6 million, which is 3.2. So you can withdraw the remainder 1.8 million. So you can withdraw out of the superannuation fund. You can invest 600,000 outside of super, and if your husband wife, most likely that 600,000 income being generated would be tax free. And then the 1.2 million gain can be given to two kids who are married. So 300,000 times 4, you can set up two new super funds and then give them money, because any money above the 3.2 million, the excess amount will be paying 15% tax. So instead of being in your balance transfer cap or being in your account, it's better that it is in the kids account, because they will also pay only 15% tax, and you're trying to help them. And you could be members of their fund if you like, and manage that money as well if you wanted to. Thanks very much. I know I've taken more than the allocated time, but I'm more or less finished, and I'm just going to go through all the questions which you may have entered. Now, those of you who have had no questions, they can log out if they like, or if you have more questions, you can enter them in your panel now, and I'll try and answer them as I go. Now, the question which I have is, are there any papers? Sorry, by Bill. Sorry, I don't have any papers for this presentation, but this presentation was recorded, and this recording would be sent to Financial Planning Association for accreditation for CPD hours, and it would be uploaded one day. Now, has the webinar, okay, can the trustee decide for, I've got a question from Valoria. Can the trustee decide for a pension to be reversionary upon the death of the member that was receiving the pension, or must it be decided by the deceased member whilst they are alive and receiving the pension? It has to be done retrospective. It cannot be done later. So if you have a pension which is a non-reversionary pension, it's very easy to convert that into reversionary pension. What we have done with our trust deed pension documents, that once you have nominated one person, you are able to nominate another person. So in case that you nominated one person, let's say one, and then you divorced and then you married someone else. So in our documents, it's easy to change the name of that person, but that's the only way you would be able to convert a pension into a reversionary, a normal non-reversionary into a reversionary pension. Okay, I have another question from Mohammed. He says, is it a must to start a pension phase if fund has more than 1.6 million in the self-managed super fund? Mohammed, you don't have to commence a pension if the member has reached the preservation age. He wants to remain in accumulation, and if he's not working, retired, if he enjoys paying tax, he can remain in pension. He can remain in accumulation phase for the rest of his life if he likes. Okay, so the next question is from Tim. He says, once you reach 1.6 million, I realize you cannot put any non-concessional contributions. However, you're allowed to put in 9.5% compulsory concessional contributions or salary sacrifice up to 25K. Yeah, that's right. Tim, concessional contributions are allowed up to the concessional. It's now no longer a concessional contribution cap amount. They have changed the word. Now it is a basic concessional cap amount. The reason of that change is because of the catch-up contributions. Like if your total superannuation balance is less than 500,000, then you can contribute more than 25,000 because you haven't contributed in the previous 5 years. So, yes, Tim, you're correct to say that concessional contributions are still allowed. Okay, again, I have a question from Mohammed. He says, an example, if 1.8 million is there, then what would be the tax rate? Okay, I think you're asking me the question that 1.6 million has moved to pension and only 200,000, the amount above is above the balance transfer cap is in the accumulation account. Mohammed, you need an actuarial certificate, and if you apply for an actuarial certificate on ECPI or on online SMSF audit, you will notice that we need the opening closing balances of accumulation and pension accounts, and the actuary looks at all the ins and out of the liability of the fund and then determine a percentage on daily balance method or on an average balance method. So you really have to apply, and if the withdrawal is on a different date and if the new contributions come on a different date, then the percentage will be altogether different. Right. Now, the second, Robert has a question. He says, if a member has 1.6 million in pension and an accumulation account, can they contribute personal, concessional, but not non-concessional? Yeah, I think it's more of a repeat of what Tim asked. That yes, you can contribute concessional, but you cannot contribute non-concessional. Now, I must mention here that if you want to retain money, if you want to retain money in accumulation. So we are here, so we could have one pension account and you can have one accumulation account. So you could have two self-managed super fund in one, but you must be careful that you don't switch on and off. That's what the tax office does not want. So you could have certain assets here and certain assets here. What the tax office thinks is that once you have determined that this fund is the pension fund, it remains in pension. But all of a sudden, if you have a huge gain, they don't want you to commute this amount, this account into accumulation and this account into pension and then claim the tax free component. So that's the kind of activity which the tax office does not want. Now, the next question is by Ramesh. He says the presentation copy is already under handout one as a PPTX file, which is available to download. Yes, if you cannot download for some reason, then I suggest that you send an email out to us. You can email it to the same email where you receive the notification, and then we'll send you a copy of the presentation. Or if you want to see a recording, you'll have to wait. I have a question from Bruce. He says, if a pension fails the minimum payment that is not eligible for ATO discretion, it is deemed to be stopped for that year. Can it auto restart for the next year, or does it have to be restarted from scratch with new documents? Bruce, in my opinion, it has to be restarted because the fund would have earned some income, so that income will be credited to that account. And because you've gone in accumulation, the taxable and tax-free component would have changed. So, in my opinion, the beginning of the following year, you need to do the pension documents again. Okay. Uh, I guess that's it for today. If I haven't answered anyone, please contact the office, and I'm happy to have a one-to-one conversation with you guys. Thank you very much for attending. I'm going to stop the seminar for everyone. Thank you.